Okay, let's talk shop. Today is Tuesday, November 4th, and Scott and I are in Wilmington, Delaware at the amazing Vincenza and Margherita Bistro. And Margherita, please, what drinks do we have for us here today?
Wait, there's drinks
We've
here?
We've gotten a toasty espresso martini and the house specialty, which is a limoncello iced martini.
Correct. Homemade limoncello, homemade lemon ice, and of course a little bit of vodka. Enjoy.
Amazing.
Wow, thank you so much.
So much. So Scott and I are on the road for a few days, getting the pulse of the retail investor in this all-time high market with some extracurriculars going on and the political world and geopolitics, etc. Scott, happy to be here. Let's have a quick cheers.
Quick toast, absolutely, Jake. We'll try the merchandise.
This is a 10-12 a.m. Martini.
No, it's not.
For us.
It's 5 o'clock just around the corner. It's 5 o'clock, about 7 hours from now.
That
and
is.
We're doing great. It's absolutely magical. And I mean, I've never seen a drink like this that has actually the lemon ice.
Yeah, try that out.
Lemon ice. Man, very good.
That's as good as it looks.
Very well done. Very well done, Vincenza and Margherita, because this is a great place to come and just not only do podcasts, but I think also have some food. The Sicilian pizza is amazing here, as is the chicken parm, some of the pasta. Absolutely amazing. If you're in Wilmington, Delaware, please do stop by because you're missing out if you don't.
Yeah, and this is our third straight year here for an event. Got another couple events on the road, but Scott, let's dive into the fades or trades for today.
We're starting there first. Oh my gosh,
action.
this is a crazy day.
And I'm gonna start one off pretty hot in the streets right now. Fade or trade. The Fed cuts again in December for a third consecutive meeting.
I'm going to trade that only because of the fact that I know they're doing this. I mean, they're already off on the space of where they want to be. Complementary, they say, to the markets and economy, which is actually ironic, Jake, because again, if you look at interest rates and the response that interest rates have had to this great Fed cutting, rates are up more or less, or flat, let's say, to when the Fed has started to cut rates, which is not really the conventional wisdom that we expected to have. So I'm going to trade the fact that they do cut again, but I'm going to fade the fact that it's actually going to work, if that makes sense. So it's a trade in the fact they are going to do that in December, as you've correctly predicted so far. So far, so good.
I'm actually going to now take the other side and fade this. I know. I'm going to fade that the Fed is going to cut again in December. I think, we're in the midst of the government shutdown. That may be ending in a week or two, I think we have predicted. So I think we'll finally get some data rolling in. And you saw some dissension amongst the governors in, just last week about whether they should have cut. And then there's a ton of uncertainty about December. So I'm going to say by the time we get some new data in the next, literally month and a half, that we are not going to cut again in December because I think inflation is going to be persistent.
I agree, and I think there's some good data coming out in the next few days, potentially the fact that we get the shutdown taken care of too, so that could actually get the bulk of the data out there so the Fed could make their change. But how about this? Let's talk about December.
Yeah.
Consumer spending. December is a huge month for consumer spending. Q4 in general is a big quarter for consumer spending. Now, Jake, let's do a fade or trade on consumer spending, given that it's already been strong through the shutdown. It hasn't really been wavering at all. In fact, it's been strengthening. Consumer spending, fade or trade, stays resilient into the holiday season, into the end of the year.
I'm gonna trade that. We saw a bunch of, we just got through earnings season pretty much. We got a couple tech companies left to go, but saw from the retailers that spending was pretty strong in Q3. Like you said, there's the cyclicality of Q4 and the holiday spending. So I'm gonna trade that the consumer stays strong. I don't think we're at a point yet where that economic data print is going to feed into the consumer. I think we're still on the kind of the macro numbers first.
Yeah, I trade that too because, we took a flight. Actually, I feel like I took a hot air balloon to get out here because it took forever. But the fact that everything was crowded, everything's full. All the reservations at the hotels, at the restaurants, at this beautiful one that we were at today, they are very, very full, very busy. A lot of takeout orders, a lot of in-place orders or in restaurant orders. So there's a lot of reasons to believe that consumer spending is strong and getting stronger. So yeah, I'll trade that one too.
Okay. Next on the list, and we're gonna cover this topic in some more depth, so we'll stay kind of 10,000 foot view here. But Scott, fade or trade that the Mag 7 or the Mag 8, if you will, including Broadcom, is going to continue carrying performance into the end of the year.
So I trade this one, but here's the deal. Now we start to see different kind of reactions, whether it's be a Microsoft, whether it be an Oracle, whether it be even like a Palantir like today, which I know is not Mag 7, Mag 8, might be Mag 15 by the time we get there on December 15th, whatever it is. The reality is that Mag 7 will carry the performance, but there is going to be more volatility going forward here. Now that we've gotten these earnings reports, Jake, and as we comb through them as we always do, we start to see, I think, a little bit more of a market reaction that tends to be kind of a little bit more negative than one would have thought, given the numbers that are coming out, whether it's based on numbers back in the previous quarter or whether it's based on numbers that have come on, based on going on how we're looking forward in the future. So to me, the Mag 7 will carry that performance, but I think it's going to carry that performance with such a heavier load in the sense that you're going to be bumping along a lot more of a rocky way here, a rocky road here going forward than we have been expecting so far, have been experiencing rather than we have seen so far this year.
Yeah, Palantir up 150% this year, trading I think 85 times price to sales.
Ah.
Pretty insane. But I'm going to agree with you. I'm going to trade this. I don't see an end to kind of the concentration of performance in sight, at least in the next 2 months or so. I mean, we've had some incredible days that we're going to talk about where the Mag 7 is carrying the S&P to just in historic ways. You know, just insane negative decline numbers from the bulk of the S&P, but Mag 7's up, so the S&P's up. So I'm going to trade that the tech names keep carrying performance.
Well, I think they will too, and I agree with you on that because it reminds me of something else in our lives that talks about performance and talks about carrying things and carrying the ball and carrying the mail. And how about the Buffalo Bills?
Yeah.
The Buffalo Bills being involved in an amazing game, really NFL weekend this past weekend, if you ask me. The NFL has been on fire this year. I just really love how the games are being played. The Bills basically handled the Chiefs pretty well. Now, granted, that was in Buffalo, but they still dominated the Chiefs really well and didn't have those kind of like ghosts of, say, matchups past where they blew it pretty hard. And so, therefore, the Bills are back, Jake, at least as the Super Bowl favorites in the AFC.
Incredible game, like you said. I mean, I was on record last episode and saying the Chiefs are here to win the Super Bowl.
You did. So now
the Bills
what? You're
are
going to
back
fade this one?
Bills are back as Super Bowl favorites. I'm going to fade this.
Wow.
As you said, Josh Allen looked awesome again. James Cook is top 5 running back in the league. Probably the defense looked good, but there's a pattern here. The Josh Allen and Mahomes have now faced off 10 times in regular season and playoffs. The Bills are 5-0 in the regular season and 1-4 in the playoffs. So this happens every single time these teams match up in the regular season. The Bills get the best of them. We think the Bills are finally going to overcome Andy Reid and Patrick Mahomes. And in the playoffs, the Chiefs are just inevitable. So I'll say great win. They're certainly a contender again this year, but they got to fight their demons in the playoffs.
Yeah, I'll fade that one too. And those losses that the Bills have had, those 4 losses in the playoffs, have been absolutely brutal as well. The fact you have to get over those
13
too,
seconds.
just massive difficulty there. So I agree with you. I'll fade that one as well.
All right, switching to the Diamond, we just wrapped up the World Series. Fade or trade, Scott? This was the best World Series ever.
I'm going to trade it. At least as far as being such a young guy like myself, I haven't seen a lot of World Series just like you have seen many
Sure.
decades of them. I can't believe some of the endings on some of these. Now, my favorite moments were the following, so I'm going to totally trade it. First was Shohei Ohtani's second home run. I think it was in game 2, maybe, what that was. That second home run that he smashed outside the stadium was unbelievably awesome after he'd struck out so many people in the game already. And he had actually struck out the side in the top of the inning, and then he hit the first home run in the bottom of the inning to lead off the game. And the second home run that he hits, boys and girls, was an absolute jammer out of the stadium. Just to put some further emphasis on it, the way that game 7 ended with the defensive plays, and you could see it taking the toll on the players, and how they're just huffing and puffing, and the guy and the catcher almost pulling his foot off the base there to tag out to get the out at home. I think it was bottom of the 9th. Either way, the 2025 World Series brought back baseball for me because of the fact that it was kind of that matchup that everybody I don't think really wanted to see. They didn't get into the Blue Jays that much. I was more into the Mariners. I was more into the Brewers really all year just because of the relationship with the Cubs. So yeah, absolutely an absolute trade and a good thing for baseball to come back here. We just need to figure out if we can do like a salary cap or some sort of thing where at least you get at least some basis across the way to get at least some of the teams better that don't have as much money.
Some parity would be good. You've seen the players, though, are outraged about that, obviously.
Yes, they were. Shocker.
This is probably going to shock some people here, as I typically go with a homer bias, and you'd expect I'd say 2016 was the best World Series. This was the best World Series.
Yeah.
You had the Dodgers, like you said, the matchup, maybe not one everybody wanted to see because the Dodgers are villains at this point. The Blue Jays, certainly a villain on the East Coast and in New York, but you had that coast-to-coast matchup. You had the two of the 3 most expensive teams, all the star power in the world, a ton of storylines, and then, like you said, I mean, you had an unbelievable, the 9-for-9 game from Shohei, which was an 18-inning game. Yamamoto, a complete game in the World Series. That never happens.
Nope.
3 wins in the World Series. The extra, best World Series, I would say. And I was at a wedding on Saturday night when
Congratulations.
When it concluded.
Oh.
And
Not yours. Okay.
was asking a bunch of people in their 50s and 60s if this was the best World Series, and they've got a quote like World Series from like the 80s. So if you've got to go back 45 years, you know this is the best.
I agree, and I think it's one of those things too that if you're looking at a rebirth of the industry, if you're looking at a rebirth of the game, this is one of those series that if people go back, this is one of those series, Jake, you can go back, and even you and I could, being as close friends as we are, go back. I could watch any game of the World Series this year, and it was awesome. It was so entertaining and so incredible. In fact, I watched enough of it on the TV when I was somewhere that wasn't hearing all the sounds and everything. I want to go back and hear everything everybody said and all the commentary and things like that, and hear the dugouts and things like that, just to feel what everybody was
you
going
almost
through.
had a brawl in Game 7. That'd be awesome. Let me take this last one here because if you remember a couple months ago, we talked about pumpkin and pumpkin flavor and Scott's personal vendetta against pumpkins.
Big time.
This last fader trade is kind of mine. Fader trade that holiday lights should be taken down by New Year's.
I think they should be taken down sometime within a week after New Year's. And here's why.
All right.
Usually leading up to New Year's, there's so much going on. It tends to fall sometimes on a weird date because you got New Year's and Christmas about a week apart, and so you therefore have the whole stronghold with that as far as, well, we're Christmas is over, but we still don't want to let it go. So I think the goal should be take it down between a week or 2 weeks, say after New Year's, but definitely not let it go through the end of the month because by then it just looks ridiculous. And then if you're going to leave it on through the end of the month of, say, January, just leave it on the whole year round. Because why even get out there in February when it's a terrible weather situation anyway? And you know what? Sometimes people might want to see it again in February and March and April anyway, and then by then everybody's going to forget about it.
I'm glad you said that. This is one of my.
Is that your plan?
This is one of my personal pet peeves. I'm trading this all day. I think holiday lights should be taken down pretty much by the start of January. I think. Agreed, I'll give you some leeway because there's still some good feelings into the first week of January, and you've got New Year's, and it's the new year, and everybody's doing their New Year's resolutions. But something I cannot stand is when I see holiday lights, and call them, whatever, if they're colored or just the white lights, in like February or March. Like, come on. Like, February, March are sad months. We're inside, it's cold. Certainly in Chicago, it's like negative 10 degrees. So it adds, I think, some nice feelings for people. But I just, for some reason, this is a personal problem, probably. I can't stand it.
It definitely is a personal problem, but we'll go with it. And I tell you what, I think one of the things, too, maybe when in the north, if you're kind of like in that winter area, anytime the average temperature, let's say for the day, or average high is above, like, say, 50, the lights have to come down by now.
100%.
Which definitely is more of a reflection, like you said, of more of the winter months, which make people happy when there's not a lot to be happy about, given that the sun's never up and it's always cold and icy.
Speaking of not a lot to be happy about,
the markets.
The markets, if you're a cap weighted or a value focused investor, and so in our first topic here, we kind of went 10,000 foot view, as I mentioned, on the cap weighted versus equal weighted disparity. This year, so cap weighted S&P, for those that aren't super familiar, think all the companies are cap weighted.
Yes.
They're based on their market value. So the tech names are the biggest, and in equal weight, everything's the same. We've seen some incredible performance disparity between a cap-weighted and an equal-weighted index. I mean, this year, as of today, cap-weighted's up almost 10%. That should pull back a little bit today as the S&P's down. But we're pushing our third straight year of outperformance by double digits. I mean, this is a run that I was looking back 10, 15 years, and 22, 18, usually the down years, an equal weight, underperforms less. And then you've got some other up years mixed in where they're tight. This is the longest streak of outperformance by the cap-weighted S&P in almost 20 years. I mean, at some point, and this is the tech conversation, right? That these names have to stop going up eventually. At some point, we've got to see that breadth or that broadening out of the market really sustain, right? I mean, we only see days right now where we get these rotations, right? Red means rotation. So, we already said we see this continue through the end of the year. Is 26 possibly a year where the equal weight can come back?
I'm not sure, and here's why. And you mentioned the dominance. I mean, you have a cap-weighted nature of the markets, or of the. Look at you. Yeah, you're going to need a drink after this, because as I say, I don't think so. I really believe it. I mean, I really think that this is kind of one of those situations, Jake, where it's kind of like the 90s, where you're going to have your leaders lead. And you're going to have your laggards lag. And I think that's maybe growth versus value just in general, or just maybe some of the Mag 7 tech heavies versus some of your old tried and true kind of retail names, your old tried and true kind of oil names or things like that just basically are not feeling it right now. And you mentioned the difference. I mean, you're talking about a cap-weighted index that's up over 10% more than, say, an equal-weighted index, meaning if you take the S&P 500 and just equal weight everything at a percentage versus take the size of those companies as a cap-weighted amount and put them into an index and basically say, hey, the bigger companies, the bigger ones that have more more
gonna run.
earnings. Yeah, that's right. More earnings, more revenue. They tend to have more of a weight into what the performance is. So that spread is gigantic, 10% plus. And so this is the third straight year that's been outperforming by double digits. And so you have to figure there's a reason behind this. In our opinion, as we've selected some of the stock positions for some of our portfolios, we have focused a lot on growth lately because of the fact that there's been a reason to be in that area, I believe, because of the fact that the fundamental strength of those names and the numbers that we've seen in those, whether it's revenue growth, whether it's net income, whether it's total revenue even on the top line, those names have just shown an absolute ability to just outperform all the other companies that were there before. And so when you look at the S&P this year, that's where you wanted to be. That's where a lot of our portfolios have been. Because if you haven't been in these names that have done those kind of numbers or done those kinds of results, you've been left completely behind. You're getting great dividends from some of those companies, but other than that, you're basically getting no performance.
Yeah. I mean, the Mag 8, as I mentioned earlier, just includes Broadcom now. Is about 39% of the S&P 500 at this point.
Adding all up, yes.
That is
right.
every basically month we create a new record. I looked back to 2000.
Yes.
So in 2000, the biggest 10 names in the S&P 500: Exxon, GE, Cisco, Pfizer, Walmart, Microsoft, Citigroup, Intel, Merck. So you've got like
who are they?
A aggregation of different sectors, and that's just not what you see anymore. I mean, right now it is the fact that the tech names are so dominant, and like you said, it's such a. I mean, it's kind of what I was thinking, but the revenues continue to expand. The market caps are obviously ginormous. All the margins are expanding, right? These products that they're producing and capabilities that they have are so much greater than 25 years ago. Why wouldn't you expect that their market caps would expand relative to other sectors? I mean, I don't see this as that much of a concern. It's a staggering number, and the S&P is up about 17.5% this year. The Mag 8 are literally attributable to 8.5% of that, so almost 50% of performance.
Yes.
Last year it was 68% of the performance.
So they're doing great. We're getting more broad-based nowadays, right?
Yeah. I don't see it as that big of an issue. I think the point you made off the top is perfect. This is just a time in the market where the leaders are going to lead and the laggards are going to lag. And until you have some weakness in the AI spend, I think this continues. I don't think we're in the 9th inning or the 18th inning of World Series Game 4 of this run by tech.
Which, if we get another chance to see the LA Dodgers play the Toronto Blue Jays in a game like related to this, I'll be up for it. Game 8. Because here's the thing. The only thing that worries me, though, is that if you look back in history at bubbles, let's say, quote unquote, or look back at market froth, you look back at big pullbacks in the markets where you have a couple years of like, in some cases, 40%, 50% on the NASDAQ, 30% in the S&P, net. It's come at times when things have been over-concentrated.
Yeah.
You look back in the 90s, we had those issues with some of the networking companies and some of those guys, and some even the international big companies that were expanding internationally. Then in the 2000s, you had some of those issues with the housing stocks, the banks. They got really concentrated, really big, really broad, really tough. And then obviously in the 17s and the 18s, we had that occurring with some of the retail and some of the consumer discretionary names and things like that. Not as bad because COVID was kind of more of a geopolitical global risk than it was more of an economic risk.
Yep.
It just makes me a little concerned that if you look back in history, if you want to see what tends to set off that flip, it could be something like this. But then again, back in the 90s, because I remember this, Jake, because I was alive and well, and I mean, I was probably in my 20s at that point, believe it or not. I know you can't believe it either. It's like, even in the 90s, though, as we've always said about the AI trade, this feels like the second or third inning, to go back to our baseball reference today, our second or third quarter, let's say, of the game, maybe the early second quarter of where the trade is on that AI space with regards to how well the AI kind of formulation is happening here. So when it comes to there's future risk, absolutely, but I don't think the risk is here and present right now just because of the fact that we still have a ways to go, I think, in some of the valuations, some of the excess returns, and some of this, frankly, just amazing things the AI space is going to do to our economy going forward. That, frankly, is going to make the economy, I believe, more efficient anyway, and potentially able to survive some more of these shocks that we've seen previously that have occurred economically.
Yeah, agree. And I think, inevitably when there's a tech pullback on some AI spend weakness, we saw that in Meta last week with earnings reports. You mentioned an episode ago about Apple's free cash flow and how it's diminished a little bit. We're seeing that across all of the big names. So I think inevitably when you have some weakness on AI, and the market pulls back, that's going to be led by tech, and so it's going to pay to have some of those other sectors in there, and that's what being a portfolio manager is, right? I mean, 75% of portfolio managers underperform the S&P every year. It's never the same 75% every year. That's because you can't be a PM and just say, here are your 8 stocks. It's the Mag 8. And so even in the strategies we run that are large cap growth or pretty concentrated strategies, there is sector diversification in there. And
100%.
so you have to be in the tech names to participate in the growth, but you also do want to keep some exposure to those cyclical names and those defensive names for inevitably when there is a rainy day or a rainy month.
Yeah, and even a rainy half a year or quarter, as we've seen. And I think your point's well taken. It's not like we're abandoning some of those tried and true cyclical names that still need to be in there: industrials, financials, those guys, even pharmaceuticals. The trouble is, I think these days you don't just buy the sector itself. One of the things, we're big sector guys. We like to trade sectors. We like to move in and out of sectors, as well as the individual names that are in the sectors. But if you're going to go to those sectors, there are kind of those secondary pinch hitters, if you will, to keep going that way.
Yeah.
The folks that are coming off the bench, the pitchers that are maybe sitting in the bullpen most of the game, those guys are great to have in your portfolio, but the reality is only buy some of those that have the fundamental strength that really back up why you should own them. And that comes back to our analysis, a lot of things that we do at Kingsview through our Kingsview Investment Management strategies, where we don't just buy things willy-nilly, broad-based. We don't just grab a sector and say, hey. We find out a reason, and we find out many reasons to buy certain stocks that are within those sectors to make sure that you're getting the best of the best of what may not be the best sector in the world, but a sector that does complement some of that AI, some of that tech stuff that's been so hot.
Yeah, a crazy stat that happened last week that I just want to leave this segment with. But on October 28th, there's 503 names in the S&P 500. 398 of those names were down on October 28th, but the S&P was still positive on the day, thanks to Nvidia, Amazon, Google, those incredible earnings and new deals that came out. I mean, that demonstrates the magnitude of how much power that these 7, 8, 9 names hold in the S&P. You had almost 75% of stocks in the index down, and we were still up slightly because of these giants.
Yeah, I mean, it's wild, and I mean, close to, in some days it's been close to 80%, where there's been a little bit less. There's been maybe not as much as a positive number, but there's been like 80% of them are down big time, and we're only down a couple basis points. You know what I mean? It's a scary thing actually to see that, both because it was coming up on Halloween, as we've seen some Halloween drag creations still around. Very, very spooky. I love Halloween myself, so that's great. One of my favorite movies of all time was Halloween, starring Michael Myers.
V&M's got it all going.
V&M's got everything going, and they kept it up for us because we want to talk about how great Halloween is and how lovely these ladies are who run the restaurant. But more so too, it's like if you look back at like some of those names, not only does Nvidia and Google tend to carry the index some days like that, Amazon, but some days, Jake, if you have Nvidia and Google doing well, or somebody makes a good comment from Microsoft or something like that, all of a sudden it raises the value or raises the perception of the other companies with which it's competitive. It's competing just because they're a competitor, they're in the space. So all of a sudden you have no news coming out from, like, say, the Amazons, the Microsofts, the world, the Microns, whoever it is, and then all of a sudden NVIDIA comes out with something that they're doing with OpenAI, and all of a sudden everything's blowing up again in that sector because of their news. And so that just goes to show you there's still that kind of gumption out there, at least still those guts for people to go out and buy a lot of those names and still chase these names and still be, somewhat optimistic about these names, because of the fact that those news pieces definitely carry a lot of things a long way, and that's something too as an investor you got to keep in mind.
Yeah, absolutely. So things to keep in mind as an investor. I'm gonna let you just kind of go off here, because as you said at the top, I've been right about what the Fed's plan was for the back half of the year.
Thanks for reminding me.
The consecutive cuts. You, though, as we know, were on the front lines of do not cut and maybe hike.
Yes.
And I know you had a very adverse reaction last week to the cut. There was some uncertainty leading up to October 28th whether the Fed was going to cut or not because of the lack of data. We got an alert about 2 minutes before the cut that they were going to cut, something that we already knew. But just go off, King. I mean, this is bad. Right? You don't like this cut?
I mean, I'm not dealing with it very well, and thank goodness I have the limoncello here, because here's the thing. I had a very adverse reaction to it. I didn't drink for days because I couldn't stand the fact that we're cutting interest rates, sports fans, in an environment that, other than a government shutdown, which has its own implications and its own statistics regarding what it's doing or not doing. It's like, why are we cutting rates in an environment where we have the market at all-time highs? We've got corporate earnings at all-time profit percentages, as far as the most profit margins we've ever seen, all-time revenue growth, all-time revenue numbers, net income numbers are obviously off the charts. Price to earnings ratios, let's say, you mentioned one earlier. I mean, PE ratios are pretty high too, okay? So they're pretty big. And then, of course, always, we've got consumer spending numbers, as the consumer usually is in big expansionary times. Consumer spending numbers are at all-time record highs. GDP in the United States was just coming off a major read for Q2, I guess it is now, because we skipped Q3, or we'll get the Q3 numbers, but the Q3 numbers are going to be good, as I almost broke my microphone there because I'm so angry. We're getting there. Q3 numbers, or Q2 numbers rather, and by our estimation, we're going to still be above, say, about 3% GDP, maybe the overall growth of the U.S. economy. President Trump, who, depending on the day, we love or somewhat love him or somewhat don't. I don't know, wherever you all fall on that. Talk to us about how great the U.S. economy is, the best in the world. We got the greatest trade deals coming down the pike, et cetera, et cetera. We've got all these great things, and so on and so forth. Your hair looks especially great these days, Jake. I mean, that's good. My hair is growing back. I mean, there's all kinds of amazing things that are happening, both kind of personally and professionally, that would suggest that there's not a reason to come out to a situation like this where, because maybe the housing market's a little slow, maybe rates feel a little bit higher than they typically did in the past, just because we got to zero interest rates, and that was clearly not a great move, as we've seen overall, because what it did to inflation since then. Now we think that the rates have to come down again because they just feel a little high. The reality is rates should be right where they should be because the market is taking care of them. And that's the biggest thing that you and I have talked about. And I appreciate your tutelage of me in a way where you've been like, well, Scott, I know what rates should be. And it's like, where the market says they should be, not where the Federal Reserve says, oh, this is what we have to do and why we have to do it, versus what the markets and economy need. Because the reality is that should not be what dictates the Fed. The Fed should, or what the president says even. The Fed should be by itself, on its own, looking at data and determining what the banks need for lending, what the banks need for, say, stress on credit, et cetera, and all the things that are happening when it comes to the internal mechanizations, let's say, of the interest rate picture, as well as some of the things that are going on in the banks and the lending picture. And that's where the Fed needs to come in. And they've got all kinds of other tools that they can use besides open market interest rates, as I almost choke on my words here, because of the fact I would just implore the Fed right now, don't do any more cuts. Because if you go over, as we've seen in the past, if you go over, say, 3, 4, 5 cuts, then you're on this full cutting cycle and the market really starts to bake it in. And don't forget, ladies and gentlemen, when you get to the point when you do need interest rate cuts and the economy falls apart, you don't have them left because why? You used them all already. And that was the wrong thing for the Fed to do that they did a couple of months ago.
So that was a point I wanted to get to. You said on our investment committee call last week when we were recapping this move, you felt like they wasted a cut.
Yeah.
And they wasted 25 basis points that they could have used down the line should numbers really look poor in data. I mean, the interesting thing is especially the one thing that you actually left out on that is inflation still. I mean, inflation was lighter than expected. That came out in September at 3.1% or 3. I think it was 3.1.
3.1. Yeah, 3.1, 3.2. Yeah, for sure.
Expected, but we're still a whole 100 basis points higher than the 2% T-shirt number, which we know we're never getting to, but we're still elevated from when they got us all the way down, say last year before they started cutting again. So, I'm starting to come around to your take with the dual mandate, and obviously they're stimulating the economy, stimulating the markets, but they're kind of just putting the inflation numbers in the rear view and saying, well, it's sticky. So,
that's right.
So be it.
And isn't this the same guy, Jay Powell? I mean, Jay, if you want to just call him straight up Jay, J-Bomb, JP. And it's like, isn't this the same guy who gave us that 2% narrative the whole time? I mean, granted, different Fed governors to your point, which is a very interesting comment because you don't hear about that a lot on the major market networks and major network markets, whatever you want to call it, about how the Fed governorship is a lot different now than it was, say, a couple years ago, than it was, say, 4 years ago. So maybe the outlook is a little bit different, even though Jay Powell's supposed to be the guy in control. The point being is that, like, when you look at the Fed chairman and who's in charge there and who's supposed to be kind of making this decision, or at least helping guide his crew, this is the same guy who talked about beating inflation to a pulp. And this is the same guy who said we need 2% inflation or else we're not going to start, being comfortable. We never got that. It basically became a T-shirt that you could all wear around because it's never going to happen. And now we're back to, like you said, 3 plus. And look at where we are when it comes to the fact that we've got like the chance to blow this one.
Yep.
We got the chance to blow this thing well off the table now because of the fact that I could see inflation going back up to 4 or 5%, especially if we get too many rate cuts or if we get to a point where the markets and economy continue to fly high, to continue to get a lot bigger and bolder because of the fact that we're getting out of the shutdown. The economy is always stronger than what I think a lot of people give it credit for. And right behind those numbers are bad inflation numbers that are ready to wake up. Speaking of the, say, demons and the ghouls and the ghosts behind us, that's inflation right here. Thinking that it's dead, waiting to come out and choke us to death because of the fact that we've cut interest rates too far.
Yeah. And so what is that? I'm interested in what we kind of touched on the December rate cut coming up in the fade or trade, but we had some unwarranted or unthought dissension amongst the governors in this rate cut. I mean, look back to the September dot plot, and everybody was calling for 2 cuts. You had Stephen Myron calling back to get us to basically down 100 basis points to 150 basis points. But October showed a little different of a story, and you've had some Fed governors, talk to CNBC and some other news stations in the last week or so and say December's up in the air. And so what is the effect, do you think, on the market? Because you said it's cuts are baked in. And so the market's expecting cuts that'll be good for, small caps and mid caps and
maybe banks.
Names that need to borrow money to run their operations.
Sure.
So if we don't get a cut in December, what do you think that signals to the market, and how do you think that negatively impacts?
I think it's a great question. I think it signals the Fed doesn't know what they're doing. If you look back in history, the Fed to cut 2 cuts like that and cut them in a situation like I just mentioned in my little diatribe there, not enough limoncello to probably keep me quiet. It's like that's a show to me that they didn't get it right, that they screwed it up, and that they did the whole Trump thing. I mean, we joked about how Trump almost knocked Jay Powell over when we slammed him in the back. I mean, God knows what he's doing to him behind closed doors. But seriously, it's like the Fed, it shows they screwed up. And it also shows that if the Fed all of a sudden takes the latest data that we've gotten, which is basically nil, because of the slowdown. And now they're saying, oh, okay, now we think everything's cool. Like, really? So to me, that's just a total mess up and a screw up. And that's where, true, to your point, Jake, that's where the markets get weird. I mean, that's when the markets are going to be like, wait, okay, so you guys did cut. The rates didn't go down much of anything in the open market. I mean, barely, especially on like mortgage rates and things like that, corporate borrowing rates, and then some on the 10-year, but not a lot. I mean, we're back above 410 or close to it. It's like, there's no way that all of a sudden the market's going to be like, okay, these guys know exactly what they're doing. And then you talked about some of the turnover that's coming. I mean, we've got a new Fed chairman next year, man. And we got a new Fed chairman next year, and you got midterm elections. Well, I think government shutdown is going to be done with, but then you got geopolitical concerns. I mean, there's a lot of things going on out there that I don't think the Fed needs to mess with, and certainly they don't need to mess with by preempting this with like a 2 rate cut play here going into the end of the year, and then they suddenly stop in December because they get the religion. I think it's hilarious though now that, like you said, Mira and some of these guys or whoever else talking to CNBC. I saw a nice interview on Bloomberg over the weekend. It was a tape, but it's talking about how now there's a lot of dissension.
Yeah.
And it's like, guys, you were so sure, and now we're not that sure 50 basis points later when rates have not moved, by the way, and so the effect has not been made. It doesn't make a lot of sense to me.
Yeah, I mean, talk about an indicator that signals some uncertainty in the move. Open rates, I mean, 10-year is up a little bit, trading 413. And you've got the Fed funds rate at 375. That's a pretty big delta between where they signaled the Fed funds rate should be and the 2 10-year. I mean, this is not the reaction we saw last year where open rates absolutely spiked.
Yes.
But again, the bond market seems to tell a different story than the equity market. I think the equity market shows some enthusiasm around just return and performance and tech names, where the bond market obviously is much, much, much bigger. And they're signaling that they don't tend to agree with the second rate cut. So I think the smart money might side with you there. The retail money might side with me. But again, I'm saying no cut in December. Based on all this stuff. And, like I covered earlier, our long national nightmare of pumpkin season is over. But
Thank goodness.
The other record that's extending into today, and we're looking at Thursday as day 35, but the government shutdown. We talked about this 2 weeks ago and 4 weeks ago. The record was 34 days back in 2018.
We hardly knew you.
We are now on day 34 right now, November 4th. So when this comes out tomorrow, we'll be at day 35, a new record. Trump has said on 60 Minutes,
right.
Both are Trump, 10 years. He said on 60 Minutes, he said just nonstop, he is not going to deal with the Democrats. He's not going to go in and bend to their knee, as he's basically saying. So how do we have any way of stopping this besides what we covered in the last episode, that there's going to be some urgency around Thanksgiving and the holidays?
There is, and I think that's going to be the biggest thing. Trump may not bend to them, but I think some of his congressional members might. I think there's a slowdown coming very soon. Or shutdown. I think the shutdown's going to be done soon, and I think that's because we might start worrying about some sort of slowdown at some point, which is going to be fabricated, but that might be the argument. In fact, the biggest joke that I love about is that some of the Congress, the Congress are meeting together. They're trying to get stuff together. We got a lot going on, obviously, this week with some of the elections and things like that going around, and some of the data that we hope to be gathering to release later. But it's like you've got members from Congress going on a longer, say, goodbye or vacation or whatever you want to call it for the weekend, and taking a couple extra days or taking a while to get back because their flights are delayed, getting home to where they need to get home or wherever they're needing to go because of the government shutdown. Like they're taking extra time away from work because they can't get to where they need to go because of their shutdown that they've caused and the fact that it's backing up the travel. So to me, if that's not a one way of showing them or showing somebody like that actually means something, what's going on here, I think it is. And I think it's just another thing that we talked about where it's coming up against a major holiday season. It's coming up a situation where you have midterm elections next year. You have a lot of things you don't want to risk as far as maybe say the public face. And Trump can say whatever he wants on 60 Minutes. Most people do if you watch 60 Minutes these days. I mean, I don't know what exactly goes on with that programming or the editing. However, it's a point to know that like, the reality is that Congress, I think, wants to get this over with. I think it's starting to get a little bit long in the tooth. And so I'm expecting it to happen sooner than later. But then again, if this goes through the holidays, that's a whole nother can of worms that we could be opening when it comes to next year, but also the data that comes out of the holidays that we so rely on for spending, for example.
Yeah, and
travel.
You spoke to some executives over the weekend who said that there might be some signals that this is going to end this week or next week. And you mentioned Congress going back to D.C. There, like we mentioned before, there's going to be thousands of employees who are not going back to D.C. as they continue some trimming of the government, bureaucracy and jobs. But we're also starting to see like a slew of corporate layoffs here. You had some big names like Amazon's laying off 15,000 people. UPS is laying off 48,000 people. Intel is laying off another 30,000 people. Microsoft. So I think the jobs data, whenever we get it next, is going to signal a different economy than we left it with before the government shutdown. And I think that's something that might be a little jarring. Maybe that's going to be priced in by the time that government shutdown ends and the market kind of digests that information. But I'm looking towards early 26 and saying that this could be some flashing red lights for the R word again.
It's a hell of a concept because, think about it. You're coming out of this shutdown. You're kind of coming out of this fog, if you will. And all of a sudden, you've got this economic situation that was, like you said, not how you left it. And the Fed's been cutting rates and all these things have been going on behind the scenes or in front of the scenes. And it's like, or in the scene. And it's like, wait, this isn't working. And so it makes you wonder, though, Jake, what's doing that? Like, what exactly is behind the Amazon cuts? What's behind the UPS cuts? What's behind the Intel or Microsoft cuts? Because these are companies that are actually blowing up as far as revenues. And some of them are. I mean, UPS maybe not so much like Amazon, but blowing up as far as revenues and profits and kind of essential essential components of the economy. And I mean, you look at Intel. I mean, Intel was basically left for dead years ago. Didn't cut that many jobs. Had cut them and then kind of leveled off. And then now they're getting government infusions and they're getting other things.
I mean, can you point to the government stake in Intel and say that's why they're cutting off jobs?
Possibly, but then how do you explain the Amazon one where all of a sudden they come off record earnings and they're talking about all this AI growth? And maybe it's AI, maybe it's AI related, but it seems shocking that all of a sudden these companies would come out and have such big numbers and such big cuts. It makes you wonder one of two things. One, is the AI impact that big? Two, are they just trying to get ahead of that data so that like when they do actually have to cut, maybe they don't do all the cuts all at once so that over the next couple of years they do them? Or three, is it the fact that, hey, look, maybe these companies were bloated anyway? I mean, maybe there was too much hiring, too much stuff that happened outside of COVID or coming out of COVID, and they got totally bloated and blown up outside the other administration because they had to get back kind of on the realm here. And so now they're probably just maybe unwinding that kind of rebloatation that they had coming out of COVID after they got smashed, from 21 or 20 to 21 to 22. So there's a lot of weird things going on that I think really need to be shaken out. But I agree with you. I mean, some of those numbers are absolutely striking, and it's probably not the end of them that we're going to see.
Yeah. One last note on the AI spend and kind of the impact of that. I heard an interview with Sam Altman, OpenAI CEO on CNBC this weekend, and he got kind of contentious with the interviewer. And the interviewer was like, how can you justify a $1 trillion possible opening market cap on 15 billion revenue? And he was snappy, and he's like, trust me, we have way more than 15 billion revenue. Guy asks, what if you have 100 billion in 2028 or 2029? And he insta said, how about 2027? So, he must think that the impact they have for some of these companies, we've seen all the mega deals come through. Another day, another OpenAI deal. If you're not with them, you're missing out.
And that's the
gotta lead
future,
to some
yes.
cutoffs.
And that's the
Some
future. And hope
layoffs,
that interview was Andrew Ross Sorkin, because
It
I
was
would like to
not.
see him get
It was
his
not. It
head
was
bit
an
off a couple
older
times.
gentleman.
Andrew Ross Sorkin, nice guy. I know him through some interviews, but he gets to be very, very heavy-handed on stuff like that, because he's right about some of the questions, whoever the interviewer was, about these are data points that are expected and projected, but Sam and some of the other folks, Matsu-san and NVIDIA, they know what's happening with regards to Matsu-san, all the guys, and the guys at NVIDIA, of course, like at SoFi, like they all know what's happening to a lot of these companies that like are going to be projecting all these numbers. They're likely undercutting a lot of those numbers. And so whether it's the folks at SoFi, whether it's NVIDIA, whether it's all the guys that are out there doing SoftBank, they're all doing a lot of those things out there when it comes to investing and kind of building up this AI space. A lot of the numbers are really undercut. They're underpredicted, and just because of the fact that you don't want the numbers to get too big too fast, because nobody will believe them anyway.
You mentioned SoFi, and also another job that should probably be taken by AI pretty soon.
Mine.
Not yours, but you decided you've said that the Titans are the worst team in the NFL for months now, and you decided to then go to the Chargers-Titans game on Sunday in Nashville. So you traveled to see the worst team. The team should be coached by AI, because they had 20 points. They didn't score an offensive touchdown. They had a scoop and score, and they had a punt return. Why were you at the game of the worst team in the league?
I had to see it for myself.
Yeah.
I had to see it to believe it.
Yeah.
I had a good deal on some tickets, and so I wanted to go down there and hang out and see a couple friends of mine. And I just had to see it for myself as to what really is going on with these games, because the NFL has been amazing from the standpoint of there's been a lot of parity. I mean, every week in and week out, there's some major upsets, and some of the upsets are gigantic too, like teams getting blown out of the water by teams that absolutely stink.
Panthers beating the Packers.
Panthers just absolutely.
That was the biggest dog to win a game outright in 3 years.
That's huge. They dominated
Since
the Panthers since the Titans. And the Vikings, I mean, the Vikings dominated the Lions in Detroit. I mean, there's all kinds of things going on. The Bears-Bengals game was absolutely bonkers. I mean, so it's kind of one of those things where I wanted to go see what was going on with just one of the teams out there, because I really do enjoy the fact that these players go out and play. They go out and play hard. The hits and some of the action is so heavy and ridiculous. It's so strong. I mean, the games are very entertaining. The weather stunk, as it has been basically mostly across the country, so that was unfortunate sitting outside. But more so, it was kind of like just checking out the actual game and seeing if I really was true about the Titans being the worst team in the league. The Titans came out and scored on a pick six within like 3 minutes of the game starting, and everybody's super excited. That was basically the most exciting part of the game. And then the rest of the game, the Titans spent the rest of, say, the 57 minutes or whatever blowing the game.
Yeah.
So it still ends up being a situation where I think there's some really bad teams in the NFL. I think you've talked well about the teams you like. The Dolphins are terrible. I think the Raiders stink too, if you ask me. I mean, they're not good. And I liked it last night too. How about this? I'll tell you a team that I don't think looked very good last night at all was the Cowboys.
No.
I mean, how do you come out and give Jacoby Brissett from the Arizona Cardinals, who wasn't even supposed to start, just basically the leeway to run all over your home field on Monday Night Football? And I mean, they couldn't tackle, they couldn't cover. So, I mean, there's just an amazing amount of things and parity going on in the NFL that really makes it exciting from a sports fan, because of the fact that I think the playoffs, just like the World Series, are going to be absolutely nuts. And it's week 9, Jake. We're already halfway through the NFL. I mean, I feel like I want a 25-week season now.
Yeah. I mean, I'll start from the end there. I know our friend that we're out here visiting is a rugby guy, so I can't talk about tries and the extra points that they have in rugby versus, the points
He's a tough
in
kid.
the NFL.
Yes.
He's a good guy back there. But, I think this is the end of the Kyler Murray experience.
Yeah, could be.
Jacoby's running this offense better than Kyler Murray is. Marvin Harrison Jr., crazy stat, I thought. Not as crazy as the S&P breadth, but Marvin Harrison Jr. last night had 7 targets. He had 6 catches.
Yep.
That's the most catches he's ever had in a game in 2 years. Well, a year and a half. But that's your number 4 overall pick, stallion of a receiver, and he's only ever caught 5 passes before last night. I think the league, you're absolutely right. The league is on fire. There are some awesome teams. My Broncos are now 7-2. They keep winning games ugly, but you got to keep winning games.
Great.
The Bears, I said the gateway was open. The Bears look like they can be 8-3.
The Chargers at the Titans game. The Chargers look very powerful. The Eagles, not too bad. Commanders, too bad. They lost some of their. I mean, I even like watching the Giants. Patriots too. Came out of nowhere. The Patriots came out of nowhere. And how about another one too? Jacksonville, I don't think is that good. They look sloppy. But I mean, Indianapolis Colts had a rough day yesterday against the Steelers. Steelers and Colts, another couple good, interesting teams that are just out there cooking.
The Tomlin experience.
And how about this? How about my team, the Vikings castaway? Sam Darnold, who signed for what, almost like $100 million or something
Yeah.
crazy because he didn't deserve it. I mean, they paid him like $4 million to play the last season in the Vikings uniform to take over for J.J. McCarthy, who got hurt in the preseason last year. Darnold blows up for the Vikings last year, and then goes to the Seahawks, gets a big contract. Now the Seahawks are awesome, and Sam Darnold looks like he should have been there all along.
Yeah. I mean, I was upset with you about your hot take in the summer about the NFL that there's going to be parity.
You did.
There is really a ton of parity
It's amazing.
in this league, and like the Chiefs are sitting in the 8th spot in the AFC at 5-4, and like we know they'll make a run, but that division now has the Chargers at 6-3, the Broncos at 7-2. I mean, they gotta go on a run here, which they always do, and get a wild card spot.
I mean, thank God the Raiders are so bad, because otherwise that division, I would think, I mean, it's not going to have all 4 teams in the playoffs, but it could have 4 teams or 3 teams at least that are like 500 the whole time for the whole year, and you get one division winner, and that's it.
NFC North looks like it's going to have 3 teams that may get to the playoffs. I mean, it's going to be a tough
gonna be
stretch
great.
run when it gets
It's going to be really tough.
I love cold football. But I
Cold
think
football, and it's going to come down to the playoff game. The playoff run is going to come down to a game or two in that cold weather in January for a game. Something crazy is going to happen, just given the fact that we've seen some amazing sports. So sit down and buckle in for that, and that's going to be exciting.
Definitely. One thing I want to wrap up on: we've got a pretty interesting situation going on tomorrow or today as this airs. The Supreme Court is finally hearing a case on the legality of President Trump's tariffs, and basically how he's not levying tariffs, because that is as the president of the United States, that is something you can do with an executive action, but essentially negotiating with countries to take off certain restrictions, to take, as we know, some immigrants back to their country. So they're finally hearing. It's been in the appellate court system for a few months. They're finally hearing this case tomorrow. Trump said he is not going to be there. Secretary of Treasury Scott Bessent will be there, so he's going to be in person for that. But what do you expect tomorrow? I think best case, right? Actually, best case for the country is that these are deemed legal. Because I think if they're illegal and we have to peel back some of these tariffs, it'll be a big blow to the administration. But B, it's just pretty embarrassing for the country as a whole to have gone through this now 7-month process since Liberation Day, hear all this stuff, all this back and forth negotiations, the big board that we talked about when President Trump brought that out, and seemingly the math
Liberation
was just
Day.
like 2x what the counter tariffs were. So best case, I actually think, is that these are deemed legal and we just move on from this. But I think there's going to be some pretty big blowback if for some reason that some of these tariffs, like on Brazil or other countries, are deemed illegal.
I agree. And I think that's like the big risk, is that they are deemed illegal, because I think the idea is that they should be legalized. They should be, just leave them alone. Like you said, just let's take this off the front page. this is not what we need right now. You mentioned about how that big board came out in April on Liberation Day, which is basically crush your 401k day. And it was like, that was like, crush your 401k for like a month. And that was like one of the worst experiences of that whole tariff kind of movement that we've had. When it came to just the data was wrong, it looked sloppy, it wasn't correct in a lot of the countries. And so for me to bring in the Supreme Court here and look for that kind of judgment or that kind of take, it's just difficult for a lot of reasons. And the fact, too, that it muddies up everything that else needs to kind of get done. So let's just make it legal. Let's just move on, because it frankly is. Let's just call it that. I'm no Supreme Court justice, obviously, but from what I've read about the tariffs and what I've read about constitutional rights and things like that, and all the things that we've written about as we've made and formed this great country, tariffs are part of it sometimes when there's a trade issue. So there you go.
And this is obviously the most aggressive tariff campaign we've seen in a long, long, long time, maybe ever.
Yep.
But I think the fact that everything's so public now, everything's online, and obviously President Trump has made it known that this tariff is, for Colombia to take back these refugees, and this tariff is for Brazil to lift these. That's the problem, I think, is that there's direct correlation between, hey, we're going to tariff you, or else, unless
you do this, right?
So that's the problem. Again, hoping that we can just get this off the front paper and just move on and deem these legal.
Let's hope so. And let's hope, too, that this doesn't drag on too long either. That's the other thing, is to have this thing hang in the background. It's one thing that just could be a notch in the belt that says, hey, we did this, we did that, it goes legal, we just tried. But let's not keep finding another way to bring this to that front page of the paper, like you mentioned, because it just gets tiring. And we have treaties, we have trade agreements, we've been decades and centuries with other countries trading and trying to do these back and forths. And this one just feels a little bit heavy-handed right now.
So we've got some of our guests lining up for lunch here at V&M Bistro for our event. So let's leave the listeners, Scott, with one number to watch between now and the next episode in a couple weeks.
You first, because I want to hear your number, because I got a number off your number, I believe.
Okay, I'm gonna go with 3.2, 3.3%. I hope that wasn't your number. I think when we get an inflation number for October, whether that is this Friday or in 2 weeks or 3 weeks, depending on the government shutdown, look for that inflation print. I think we need it to be lower than 3.1%. Otherwise, the Fed is going to be in trouble. I think the market's going to have a little shakiness, as we've kind of said, because they cannot keep lowering rates if inflation keeps going up. If you want to say it's sticky where it is, and so we feel comfortable lowering rates to deal with full employment and everything else, that's one thing. But if you have inflation continuing to spike, I don't think you can keep lowering rates. So look out for inflation print higher than it was a couple weeks ago.
Well, you're right. I'm going to stay on that kind of tip, but I'm going to go further. I'm going to say within the next, year, let's say maybe cut it down to 6 months, because of the data that we're starting to compile on our own. The number is 4 for me. It's 4.0, and I think we're going to see a 4.0 CPI print here in the next, especially if the Fed cuts rates in December. I think we're going to see a 4.0 CPI print here in the next 6 to maybe 8 months, by around the summertime, by the midterm elections, because there's too much stuff that's piling up, that's kind of going on and going through the economy, in my opinion, that's starting to kind of lift prices or at least stop them from going down. So your point is well taken. I think that CPI number short term is very, very true and tried and true. But as we get these more of these rate cuts, as we get the economic growth that's going out there, I'm still a believer that with the tariff stuff we were just talking about, that starts to come off a little bit as far as the stress and the strain. But still, if you want to walk around and figure out how big and how great the economy is, just go to a restaurant. And I don't just mean V&M's restaurant, because you need to come here because it's awesome. But go fly a plane and go jump in a plane if you want to drive. Just go ride in a plane if you want. Go get a hotel room. Go downtown somewhere. Go out in the suburbs. Things are full, things are busy, roads are crowded, a lot of appointments are being made. So my opinion is that's an inflationary indicator, if anything, and so therefore I'm looking at a 4% number, a 4.0% number on CPI sometime by, say, June of next year.
Let's hope I'm right.
I'm not right.
I want to thank Vincenzo and Margarita again
Cheers.
for hosting us at V&M Bistro.
Thank you.
We'll do a cheers, and we'll see you in 2 weeks.
See you.